Hey, Kevin here, top 100 financial advisor and best-selling author, and we are here to talk about the stock market. It's Friday, which means that it is time for Grade My Portfolio. So this is episode 2 of what I hope to be a really fun series. Do go back to episode 1, recall all of the rules. I'm not going to have to repeat them every single episode, but I will briefly restate some of them here. So remember, this is for fun. This is my opinion on the portfolio that were submitted to me. So people will say, hey, look, I want you to take a look, tell me what you think, and I do that. Okay. So if you want yours graded, if you will, then feel free to follow me on public, add yours there, or on the comments on YouTube, add your link there. I'll check it out. We'll add it to the roster or to the list. So we got one today. We'll take a look at. Remember, we're looking at this as if this is everything that they own. It may not be. It's just my opinion. It's not investing advice, and we do this for fun, just to kind of learn what other people are investing in, how I see it, and then there's always some learning moments that we may learn about or may find out about ourselves as investors and about the person who is investing. So let's go ahead and get into it. I'm going to go ahead and share the screen now and jump right into what they have, what I think, and we'll go from there. So also, feel free to follow all the guests on the show, the participants, the students, however you want to say that. All right, so we are with Verona Whitaker. Please correct me wrong if I mispronounced it by any chance. And these are the investments that they have. So there are a lot of stocks here, a lot of stocks and ETFs here. I think the number is okay. But there are some things that immediately stood out. I'm not going to get into every single company here, but again, there are some things that really stood out to me. So we've got 3, 4, 5, 6, 7, 8, 9, 10. Then we've got 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So this is a lot of holdings. But the good thing is here that, again, a textbook, any investing textbook, 20 to 30 stocks, 25 to 30 perhaps, that's pretty good for diversification. So in theory, this is the right number of stocks to have. Now there's a disadvantage here in that if you got this many, you got to know the ins and outs of every single thing here, or at least be very, very versed in all those. So looking at the portfolio, you got your regular list, you get your long term. Again, it's all together. But I'll tell you what I like first, and then some things that were red flags to me. So scrolling through here, Pinterest is interesting. It's not a company that I follow. I haven't followed since their IPO. It's interesting. I think having some social media, whether it's this or Facebook or Twitter, just an interesting ad. I think that's okay. I wouldn't. That's not a red flag for me. But I did. I will give you a check or a point here for that. Um, you've got Zillow. That's fine. You got Amazon, which I think is good. I like BlackRock. For those that don't know, they're like the biggest asset manager. They just released their earnings. I want to say on Wednesday, and they did quite well. Y'all know I'm real big in the financial industry right now, and BlackRock was one of the stocks I looked at. I was looking at that and Citi and Capital One and a bunch of others. BlackRock, I think, is a really solid company. I would give you an A plus for that particular pick. And then you've got JP Morgan. So this is not necessarily a concern, but you do want to be careful when you do stuff like this. So you got two financial companies. Now, the reason why this is fine, I would give you an A plus for JP Morgan as well, is because while they're both in the financial industry, they do two separate things. So JP Morgan is more a consumer bank, also a bit of an investment bank, whereas BlackRock is more of an asset manager. So they manage people's 401ks and really do like the investing stuff. Whereas JP Morgan, like that still counts as like my Chase bank account, right? So JP Morgan is a little more diversified. BlackRock is kind of a different area of finance. So I think it's fine to have two of these. I don't think it would make sense to have JP Morgan and Bank of America. I don't think it would make much sense to have JP Morgan and Wells Fargo. They like y'all do pretty much the same thing. I don't want to double my risk by doing that. So I think BlackRock and JP Morgan together, I think those two are really good finds. So that's what I like. That is what I absolutely like. Now I would need to dig into all the rest of these 17 some odd holdings, which I'm not going to do here because we try to keep this short. But those are things I absolutely like. So Amazon, BlackRock, JP Morgan, and Pinterest. I think that's a decent, solid core. Now, the things that concerned me, the things that stood out to me is what we call duplication in the financial industry. What duplication means that you're copying and pasting the exact same things in different investments that you may not be aware of, and you're taking on more risk than you might want to. So for example, I've got, and these are just the ones I immediately saw. You've got 1, 2, 3, 4 ETFs down here as exchange traded funds. So that was what, 1, 2, 3, 4. This is 1, 5. I'm not too worried about that one, so I'm gonna erase that one. And then IWM. I have to recall what IWM is, but I've got, was that 5 different ETFs, and a lot of these ETFs have the exact same stocks in it. So for example, and I'll show you some of these. I know SPY is it's like a starter ETF that I think most investors should have in some capacity. But I know for a fact it has Apple in it, right? Well, I know this one also has Apple in it, AAPL. So I've got Apple here. I've got Apple here. You know, do I have Apple here? Do I have Apple? Like, how much Apple do I need, right? So I'm duplicating and saying, look, I've got Apple in 4 different places. So if Apple drops and I don't know it, I don't own it, my portfolio is hit 1, 2, 3, 4 different times, and I'm losing money for a company I don't necessarily have more control over. So you always want to be careful of that. But I want to show you specifically, how do you find out if you're duplicating, and again, the risk by doing that. And we'll also look at, I think it was IWM. So I'll add that one as well, and we can actually walk through that. So the concerns here again is I've got 1, 2, 3, 4 that could be very, 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 very similar. Could be. So we're going to actually look into that, and we'll show you how to do that as well. So we're going to share screens again as we flip to a different screen. Here you go. All right, so anytime you have an ETF, you can go onto that ETF's website specifically. You can also go to Yahoo Finance and look up holdings. So holdings is going to be along the top on Yahoo Finance. You should be able to do this from your phone as well. You can scroll down and it'll show you the top 10 holdings for any of the ETFs that you have, exchange traded funds. So I'm actually going to start with DIA. I'll slide this over here. Now, DIA stands for the Dow Jones Industrial Average. That comprises of only 30 companies, the 30 largest companies, which for diversification purposes, if I'm going to buy an ETF, let me just get the S&P 500. Like the Dow 30, they're the ones everybody knows, but that's, you know, why do that, right? When I can just get 500 and do just a bit better. So concerns here, this is DIA. Let me double check. This is DIA. We're looking at DIA right now. So you got top holdings. You got Goldman Sachs. Cool. You've got Microsoft, Salesforce, Amgen, Boeing, McDonald's, so on and so forth. And this is about 52%. 52% of this entire fund is in these 10 stocks. You can call what you want, if that's good or bad. I don't really have an opinion there. But notice some of the companies that you start to see a lot. So again, I know, y'all know I like Microsoft. So I got Microsoft here. Pay attention. I got Boeing, I got Visa, I got McDonald's. Fine. There's nothing wrong with this right now. Let's go over to QQQ, which is a very popular ETF that has been known to perform well. Look at what we see here. We've got Apple. Okay. We got Microsoft again. And I've got Amazon again. So now at this point, I've got, if I go back to my the other screen, we already owned Amazon, but now this fund also owns Amazon. So I've essentially got Amazon almost twice. I've got Microsoft twice already. That's duplication, right? If I go over to SPY, what are their top 10 holdings? Guess what? I got Apple, Microsoft, and Amazon again. I've also got Google, known as Alphabet now, in QQQ and in SPY. So again, I'm duplicating my risk. I already own Amazon as an individual stock, and I have it in QQQ, and I have it in SPY. That's 4 times for Amazon by itself. Okay, so I might not want to do that. And that's just to say, these are just the top 10. I think I've seen NVIDIA on here. Here's once for NVIDIA. I can go back to QQQ. Here's NVIDIA again. JP Morgan. I already own JP Morgan as an individual stock. Now, granted, this is only 1.29% of this fund. So it's not the worst thing in the world. I don't want to overblow it. But when you start to combine the stock itself plus 2 to 3 ETFs, again, you could be taking on a little more risk than what you are expected or what you want to do to begin with. So you always want to be very, very careful of that. We can go to that last ETF or second to last one. This was SPD. This is a dividend fund that invests in some of the companies in the S&P 500. This is fine. Okay, now I don't know how well it has performed, but it's fine. These are different companies. So you see, this is different than what we've done in some of the other ones. And this is specifically for dividends. So I'm good here. I'm not overly concerned here. I think it's okay to have SPY and SPYD, or QQQ and this, right? I think those, you could put those two together, but I don't want to do the exact same thing and just have it three different ways. I think IW, what was the other one that we looked at? I'm scrolling back. You guys can see it on the screen. IWM was the other ETF that I thought was interesting. IWM. This is the Russell 2000. The Russell 2000, a broader index, has like 2,000 companies approximately. And this is small caps. These are smaller companies that tend to grow a bit better than average, a bit better than some of the blue chip companies like a Walmart. So we can go here. We can go down to holdings. Scroll down and you see a bunch of different companies. Again, these are smaller. So you've got your AMC. That's wild. You got your AMC, Lattice. I was going to say Latrice. That's clearly not Latrice. You got Lattice Company. You've got Denali Therapeutics, Star Surgical. So these are companies I haven't heard of because these are much, much smaller companies outside of AMC. So this is fine. You've got your Russell 2000, which are your smaller companies. You can have your SPY, which are your bigger, well-known companies. Those two things go together. That's totally fine. But again, I don't want to duplicate and have the exact same thing over and over and over again. So those were the immediate things that I saw as red flags, and then things I saw as things that were fine. Okay, so what I would do, okay, and remember, your goals are going to be different. Is not investing in advice. And I also want to point one other thing before I kind of sum this up. This TGIF, this is if I remember correctly, it's a SoFi ETF that tries to pay out dividends, I think on a weekly basis, which is, I think every Friday, like pay a dividend. Don't know much about it. I think it started in 2020, I think October 2020, if I remember correctly. I think it's just interesting. Again, I don't know how it's performed. I'll look into it. I don't know what it invested in, but I just think it's really interesting. So just throwing it out there. So what I would do if this were me, again, not investing advice, just my opinion, one of these ETFs is one of them got to go. One or two of them might have to go. And it depends on how aggressive you want to be. So if you're looking for growth, you want to see your account grow consistently, and you want to continue DCAing, dollar cost averaging, then what I might do, I might keep QQQ. I'm definitely probably going to get rid of DIA. Depends on if you're focused, how much in dividends you're looking to get. I don't think it makes sense to have a weekly dividend fund, TGIF and SPYD. I don't know all the details about which is in which and if that's duplication, but this one is newer, so I'll probably get rid of that one and kind of focus. If I want dividends, then I'm probably just going to focus on the one that I know has dividends. It might not be weekly, so you want to determine that for yourself. I got to figure out what to do here. If I've already got QQQ, do I want that and SPY? It's a little bit of duplication there. You really got to see and make that decision. What else popped out? We've talked about NEO before. I'm not personally big in it, but I think it's fine if you want to take that risk. I'm not a fan of Coinbase right now. It's a newer company. They just IPO'd just a few months ago. I think that's a big risk. Now, I am not that risky comparatively, right? So you got to decide that for yourself. That's totally personal. So it's something you want to look into. Now, these two, Bets and BART, I'm not familiar with those, so I'm not going to go there. I do see this, a one-day loss of 9%. That's probably pretty volatile. I might be a little concerned there. So those are just the immediate things that stuck out. I think the big thing is always you got to watch out for that duplication. Now, duplication is okay to a degree, but you just want to be aware of it, because anybody that has an index fund and owns Apple or Microsoft or Google, you're gonna get at least that twice, right? But in this case, with Amazon and JP Morgan, we saw it 3 or 4 times. And it depends on how much money you got in it, that if one thing happens, then you're losing more times than you should. So if you want to own the stock and a fund, fine, but it doesn't make sense to have a stock and a fund and another fund and another fund and another fund on top of that. So you just want to be very, very careful of stuff like that. Always look into the holdings to see if you start to see the same name over and over again. Also pay attention to percentages. One of the funds, I think for JP Morgan, I think it was 1.2 something percent. That I'm not overly concerned about that. So notice I wasn't concerned as much about JP Morgan, but I was concerned about Amazon because I know for a fact that it was there more times and was a heavier allocation there. So those are the things I do want to be worried about, or at least just have your eye on and be aware of. You want to take that risk, that's fine. That's you. I just gotta make you aware of that. So if this were a client that came to me, I'm saying, look, we need to sit down and make some decisions about who you are as an investor, what fits with you and your philosophy, what fits with you and your strategy, and then we'll decide whether or not that makes sense. So if I were to give this a grade, I'm gonna have to go with a D, just because of the duplication. D for duplication. There we go. But again, we don't know their goals. They could have a whole bunch of other stuff elsewhere, right? So these are things that you can always change, things you can always kind of move around and adjust. But I think it's a teachable moment for all of us to make sure, that you're not duplicating, that you're not getting into a situation where you're taking on too much risk without knowing. Now, if you know that, you're good to go. If you don't know that and you start to see that your stock is dropping, like why am I losing, $200, $300, $400 today? What, Apple dropped? I don't own Apple. And you look into your funds, oh damn, I own Apple 4 times. That's why I'm losing money, right? So you always got to be aware of that type of risk. You don't want to over duplicate, and if you do, you want to be aware of that. So that's it for me. Let me know what you think. What are some things that you thought were interesting? Some things that stuck out to you? What did you learn? What did you not learn? Feel free to let me know your thoughts in the comment. Hit the like button, subscribe button. Like 80% of y'all don't subscribe. It's free. Gonna do that. So do that, sign up, all those things, and I'll talk to y'all, I guess, on Monday. All right, talk to y'all later.